Hello, everyone. My name is Corey Daharsh. I'm here from Advanta IRA with another educational webinar. And today, my presentation is going to be on the Checkbook Control IRA or the single member LLC strategy. So hopefully you're here to pick up some knowledge. If you already have a checkbook control or you're interested in learning more about it, that's what we're here for today. Just a little bit of background on myself. I've been with Advanta IRA since 2016. So later this year, I'll hit my 10-year mark with the company. I've worked a number of different roles in the company. So I've been a client account manager, handling day-to-day transactions for my clients. And I've also spent a lot of time on the business development team doing education, networking, and teaching people how these products work, these self-directed accounts and the different investment strategies you can utilize with them. So that all to say, I have a wealth of knowledge. I've got what's called a CISP designation, Certified IRA Services Professional, that I've held since 2018. And if you have any questions beyond what we're talking about in today's presentation, you can feel free to take down my contact information and reach out to me directly. I'll be very happy to answer any questions, help you or any of your friends, family members, whomever you think could benefit from learning more and possibly establishing their own self-directed retirement account. So a little bit of background about Advanta IRA. We're a full-service, self-directed administrator and custodian, and actually trust company at this point as well. We've got about 15,000 active clients that hold just over $3.5 billion in assets under our administration. Each client of ours has a dedicated client account manager, again, a role I served for about 5 years, where you have a one-to-one person to reach out to when you have questions about your account, questions about the rules and strategies that you may be interested in. You're not having to deal with a call center and explain who you are and what you're trying to do to a new person every time you pick up the phone or send an email. And then finally, all funds that a client have with us that are not actively invested are insured with FDIC institutions. So your money is safe while it's not actively invested. It's not earning for you in that capacity during that time, but it's not going to go anywhere, and it's ready to mobilize as soon as you find the deal that you're interested in utilizing. But again, we're here to talk about checkbook control today. So even more so than that, your funds are going to be in your hands at your financial institution of your choice as soon as you establish this checkbook control LLC. So a brief coverage of my agenda for today. I'm going to give you some basics about self-directed retirement accounts and then some basics about the checkbook control strategy, how to go ahead and set one up, what different considerations you should have, and how easy it is to actually set up this LLC strategy. I'm going to bring in some real life examples and some legal considerations as to what it looks like to actually go from 0 to 100% in setting up this LLC. And then I'm going to give you some case studies on what it actually looks like to set up an LLC through 3 different actual options. There's 3 different ways you can obtain checkbook control, and I'm going to give you a case study for each of them. And then at the end, I'm going to round out with some questions and answers. If you have any questions, you can use the Q&A box in the panel here to go ahead and address those. And as long as they relate as I'm presenting, I may answer them. Otherwise, I'll have a full Q&A session at the end of the presentation as well. So a brief disclaimer before I get too much further. I want to let everyone know I'm here for educational purposes only. I am not qualified to give you tax advice, legal advice, or financial advice. So just understand that this is an educational presentation, hoping to explain to you and give you some guidance and feedback on what a checkbook LLC is and how to establish it. But I'm not giving you any tax, legal, or financial advice, nor is Advanta IRA as a company. So if you haven't heard about self-directed retirement accounts, that's actually very common. Not a lot of people know that these accounts exist, typically because you have a fiduciary account with a financial advisor that is investing into publicly traded assets, stocks, bonds, mutual funds, things like that. And those companies typically try to possibly make you think it's too risky or too volatile to switch over to a self-direct account because they have a vested interest in you keeping your money in their hands, where they're charging you interest or points or percentage on the investments that you make. So what we do with the self-directed account is, again, we help you follow the IRS's rules and regulations and put your investment transactions completely into your hands, where you pick who, what, how, where, and why you want to invest. And we make sure that criteria falls in the IRS's compliance and help facilitate those transactions. Or in this case, help you set up your LLC so you can facilitate those transactions even more in your own hands. I do see the first question that popped up here. What are the annual reporting requirements to the IRS? There are no annual reporting requirements. As far as the IRS goes with a retirement account, the retirement account is typically seen as a disregarded entity for tax purposes. So in general, you do not have any reporting requirements. When we're talking more specifically about checkbook control like we are today, I will address this a little bit further in the presentation. But when it's a single member LLC, there are no reporting at all. If you have multiple members in the LLC, whether that's 2 retirement accounts or 1 retirement account and a non-retirement account partner constituting the full 100% ownership of the LLC, then there are some basic reporting that you'll have to handle, which your own CPA or tax preparer can assist you with, or a lot of people are able to do that themselves. So a self-directed account is basically a retirement account that lets you make investments outside of those stocks, bonds, and mutual funds I referenced earlier. On the last slide, I actually didn't mention this, but only about 4% of US-based retirement accounts are currently self-directed. In the grand scheme of things, there's about $40 trillion in US-based retirement accounts. So in perspective, there's about 1.5 trillion that's actively being self-directed, but the other 96% roughly of people that hold IRAs and 401ks and various retirement products either do not know or just have not tapped into their ability to self-direct their accounts yet. Mainly, as I stated earlier, just because they don't know that this even exists. So being here, participating in this webinar is giving you a leg up on a huge portion of investors trying to prepare for later on in life. So going into what type of plans can be self-directed, at Advanta IRA, we offer your standard traditional and Roth IRA accounts, which most people are familiar with. We also offer plans for small business owners or self-employed individuals. Those would be your solo 401ks, your your solo 401ks, your SEP IRAs, and your simple IRAs as well. And then separately, you can also have a Coverdell Education Savings Account or a health savings account that are able to be self-directed if you've got a high deductible health policy or a young one in your life you'd like to set aside money for qualified educational expenses. So why do people choose to self-direct? First off, it's a new source of capital when someone's already doing some sort of unique investment strategy. If you're already investing into real estate or private lending or anything really, cryptocurrency, and you realize that you can use your retirement funds to bolster that type of investment strategy, well, maybe you just move a portion and you diversify your retirement account. You keep a portion in the public sector with the fiduciary and you break off a portion to start self-directing. Or maybe you're completely tired of the stock market and you want to move everything. So fatigue in the stock market is really the second criteria for why people switch to self-directed accounts. Over the past 4 or 5 years, the public sector has been a pretty wild roller coaster ride. So we've seen a lot of people just get sick of it and switch over into self-directed strategies. And finally, the tax benefit of making these investments with your retirement account is going to help in many different ways. Once you make your retirement account investments and you, let's say, sell an asset, there's no capital gains to be paid on that investment when it yields returns. The only time you're paying taxes on your retirement account investments are typically later in life when you actually distribute that money out of tax deferred accounts. With Roth accounts, you really never have to pay taxes. And then in certain unique niche investment scenarios, there are some taxes that may apply, like UBIT, unrelated business income tax, or UDFI, unrelated debt financed income. We've got separate webinars on those topics specifically, so I'm not going to get into those in detail, but I do want to just share there are immense tax benefits to investing with your retirement account. So the rules and regulations are pretty simple to explain, and this is the broad scope of what you can and cannot and who you can and cannot invest with using your retirement account. So this is going to apply to anything you would do with a checkbook control IRA or a single member LLC. In the scope of once you have the money in that LLC, you can invest into anything you'd like to within these rules. So there are certain assets labeled as prohibited investments. And those are basically anything with a subjective value. So antiques, fine wine, artwork, anything the IRS would consider subjective, they don't necessarily want you to hold in your retirement account. You're also limited. You're not really allowed to invest into life insurance policies. There's certain kind of gray areas. If you have a 401k, you can possibly invest into life insurance. But for the most part, life insurance is also a prohibited asset. Aside from that, pretty much anything else you may want to invest into, there's likely a way to structure that investment. You just need to speak with your account manager with us, and they'll help you strategize and structure it. They can even send you a dedicated instruction email that tells you exactly how to facilitate whatever investment transaction you're interested in. Now, the other way that the IRS restricts these accounts is by labeling certain individuals close to you as disqualified persons. And you're not allowed to transact with these persons, although you can partner with them, which I'll get into a little bit later and actually briefly mentioned earlier when answering that first question from our audience. So your disqualified persons are basically your parents, your children, yourself, your spouse, and any businesses that those individuals own or control day-to-day operations of. So those are entities and individuals you can't transact with. I can't buy an asset from a disqualified person. I can't sell an asset to a disqualified person. I can't let a disqualified person benefit from an asset held in my retirement account. Aside from that, the only other rules are something I referenced on my last slide with the UDFI and UBIT tax. So I'll just explain it a little bit further, but again, I'm not going to get into the weeds on this topic. UBIT, or unrelated business income tax, is a tax that's levied on investments you make that are generating some active income. It's important to understand the IRS with these retirement accounts expect you to generate passive income with your investments made. Sometimes a passive investment may generate some active income. For example, you may invest into a car wash or a laundromat, something like that, where there's actually goods and service being exchanged with a consumer and thus active incomes being generated. You may have to pay UBIT tax on that active income. It's not a disallowed investment. It's just a caveat and something to be aware of if you're going down one of those strategies. Now, the other tax I referred to, UDFI, unrelated debt financed income, is a tax levied on any leveraged portion of investment you make. So let's say you go out and buy a rental property and you have $300,000 in your retirement account and the property is valued at $500,000. So you're having to buy it for $500,000. Your retirement account's going to have to take out a loan, and the portion of that property that's leveraged via that loan is going to be subject to UDFI tax. It's sometimes a deal breaker with people doing underwriting on these types of investments. Sometimes it's calculated in and it still works out. But again, if you're interested in either of those specific topics or niche nuances in these strategies, we have separate full long educational webinars and presentations on UBIT and UDFI tax. Disqualified persons, here's just a chart to illustrate what I was describing. But again, it's your main trunk of your family tree. So your parents, your grandparents, your children, your grandchildren, any businesses that these individuals own, as well as yourself and your spouse. So you may note siblings are not disqualified. Aunts, uncles, other distant relatives, friends, family members outside of this main trunk of your family tree are not disqualified. So you can transact with those individuals, just not the ones illustrated on this chart here that I've described here. So just a quick illustration of some alternative assets. Again, we're talking about checkbook control today. So once you have the funds in your checkbook LLC, you can essentially invest in anything you'd like to. And that could include real estate. We see a lot of real estate investors, whether it's owning rental properties or investing into a syndication as a limited partner. This includes cryptocurrency, private lending, precious metals, anything pretty much under the sun. We've seen people do some really unique investments based on their own expertise. And when people know how to make money, when you can do that with your retirement account, like I said earlier, just adding a new source of capital to strategies you're already familiar with and already generating wealth from, it's a great, great resource for you. So talking about the Checkbook Control LLC, what it basically is, it's an LLC that is owned fully by your retirement account that you're able to invest those retirement dollars into. So there's two ways to achieve checkbook control. One is custodial. I'm sorry, there's not two ways to achieve checkbook control. One way to use your retirement account is to use it as a custodial account. So you just have an account with us. You reach out to your client account manager anytime you want to make an investment. They facilitate the paperwork and process everything, and you're holding that asset directly through the custodian or the administrator, and we're facilitating your cash flow in, cash flow out, and any documentation that needs to be executed for the investment. So that's one way to do it. The way we're talking about here today is checkbook control, where you're actually investing into a vehicle that is an LLC or a trust for that matter. We'll speak about that a little bit further later. And we basically fund an investment of your retirement dollars going into that LLC or trust account. And then from there, you as the manager of your LLC or your appointed trustee that's a non-disqualified person are able to actually transact in the name of the LLC or in the name of the trust directly without having to come back to Advanta every time you want to make a new investment or have to facilitate any changes or updates to your investment, cash flow in, cash flow out. You're handling all of that yourself when you establish this checkbook control. Oh, sorry, bear with me. I switched it to full screen on my deck and I did not see the panel to advance my slides. So some basic rules for checkbook control are that it must be a manager-managed LLC. So there's two different ways you set up management when you establish an LLC. It's either going to be member-managed or manager-managed. And it's important in this case that you set it up as manager-managed because your retirement account is going to be the member, and your retirement account is not a human being capable of making day-to-day decisions. So it's important that you grant that manager-managed capacity. Typically appoint yourself as the manager. You can appoint yourself plus your spouse or a business partner or someone like that, or a third-party service. But at a very minimum, most, if not all clients that I see appoint themselves as the manager and not a third party, or possibly themselves additionally a third party as well. You can include more than one member. It can be multiple retirement accounts or a mix of retirement accounts and non-retirement accounts. But it's important to note, as I stated way earlier, if you have multiple members, there is going to be a tax filing required for that. And it's also important to note, once you set up this LLC, the membership is effectively locked in. So if you set it up 50-50 and you and the other member both bring $50,000 to the table, and 2 years down the road, you need $20,000 more in this LLC, that means you and the other member both have to equally contribute $50,000. You cannot dilute ownership by covering for someone else or vice versa. You'll have to make sure, if you're planning to do a multiple member LLC, that any future considerations and additional contributions into the LLC are going to be set at that ownership percentage, and that's not going to cause an issue with whoever may have a bigger or smaller pocket available to them, if you will. Additional capital contributions can be made very simply. It's just moving money into your retirement account and then having us execute an investment to move that money furthermore into the LLC's bank account. You may include provisions based on prohibited transactions, just so you're having all your bases covered and any possible prohibited transactions can be avoided. There's no tax return required for a single member LLC. And just if you're wondering with the IRS rules I described earlier, oh, you can't do any self-dealing. There is case law that supports that you're able to be the manager of your IRA's owned LLC. That case law is either Swanson versus Commissioner or the tax court memo of T.L. Ellis. I implore you, if you're interested in that type of thing, to go ahead and research that. You could do a simple Google search for either of those. Excuse me. So there's a few different ways to achieve checkbook control. The primary way we see people achieving checkbook control is just through a single member LLC. When it's an LLC, the manager has the duties of handling all the transactions, executing any paperwork. The other option is a trust. When you're establishing a trust, you cannot be the trustee of your IRA's owned trust. So you do have to appoint a third-party trustee. It can be a non-disqualified relative. There are trustee services out there that you can look for and employ. But basically, you won't have direct control. You'll have to go through that third-party trustee. one of the key reasons people use a trust as opposed to an LLC is a little bit further anonymity. The trust is not public record, whereas an LLC is technically public record. So if someone looked up your LLC, they'd see that your IRA account's the member of the LLC, and possibly that you're the manager. So for anonymity, people use a trust, but for the most part, people simply use the LLC route. So establishing the checkbook control is a pretty simple process. What you basically need to do is you need to go to the IRS's website and file for articles of organization. That takes about 20, 30 minutes. I did this back in 2024 for my own LLC, and it was a very simple process on the IRS's website. You then need to also provide an operating agreement. We don't have any stipulations aside a few bullet points that are provided when a client sets up an account. Basically the manager management, like I said earlier, and some sort of Schedule A or Exhibit A that breaks down the total initial capital contribution. If there's multiple members, making sure that those contributions add up to 100% ownership based on the exact dollar amount being brought into this LLC. And once you have your articles of organization, you'll have a tax ID number. Once you have your operating agreement, you can provide those items to your client account manager and also go establish a bank account. So as far as opening the bank account, you use the tax ID number that's established for the LLC. You provide them your operating agreement typically to show that you're the manager and capable of signing on behalf of the LLC. And then you basically go to the financial institution of your choice and tell them, hey, I'm the manager of this LLC. I'd like to establish a bank account, a basic business checking account in the name of this LLC. And they'll establish it for you in that capacity. One thing I do like to mention is that when you're establishing the bank account, you typically do not want to tell the bank representative that you're setting up a LLC for your retirement account or your retirement accounts LLC. As soon as a general bank associate hears the word retirement account, they're going to put you in touch with their salesperson, and they're going to try to sell you on a IRA or whatever retirement product you have through their financial institution, which again, as I stated at the beginning of the presentation, they're fiduciaries. So they're not going to allow you to do checkbook control. And it's really just based on their knowledge of what you're trying to accomplish here. And I don't speak out of turn here. I was a bank teller for several years, and that was what we were trained to do. So I put myself through college as a bank teller 4 or 5 years in that capacity. And I didn't know at that point anything about what I'm teaching you here today. So you would basically just kind of be overwhelming that bank center associate. So again, the easiest way to set up this bank account and just say, hey, I've got an LLC. I'm the manager of it. Here's my articles of organization and my tax ID number. Here's my operating agreement to prove that I'm the manager capable of signing. I need a basic business checking account, possibly a savings account. One thing to note is you're not able to establish a line of credit in the name of your LLC. So make sure you don't open up any credit lines at all. That's not allowed because again, your retirement account is not a human being and not able to sign a personal guarantee or open up a line of credit in any capacity. So when you're filing the LLC articles, it is important to note that you typically want to have LLC or LC in the name. It's required in most states. We typically want you to avoid having Advanta or IRA in the name of your LLC as well. As far as a registered agent, you can use your home address or your business address and list yourself as a registered agent. You could also list a third-party registered agent service if you'd like to. That's typically going to be something that you get charged for. So in most cases, people don't do that. And then the management, as I've gone over a few times, list yourself as the manager, possibly list any other appointees as managers like business partners, friends, spouses, but you don't need to have anyone aside from yourself as manager. So with drafting the operating agreement for the LLC, as I mentioned earlier, it's very simple. You can basically just Google search single member LLC operating agreement or use like a AI service like ChatGPT or something like that. It's very simple to set this up. We don't have any requirements. So I've seen clients submit a 3-page operating agreement. I've seen clients submit a 30-page operating agreement. As long as your account manager can read through it and make sure the management's listed appropriately and a few other basic factors, that's perfectly fine. I think when I established my LLC, I went to like LegalZoom and I paid maybe $100 or $125 for a basic template that was, I think, 3 to 5 pages. So very simple and straightforward. You could do it yourself. You could be very detailed or very vague, as long as it covers the basic that we outline when we're helping you establish the account. A few other provisions for the agreement. Basically, you need to state the effective date, list all the members and managers, how members are going to be admitted or removed if you have multiple members or you're intending to possibly have multiple members, outline voting procedures, taxation of the LLC, which in essence, it's a non-taxable entity unless you have multiple members. And then you're going to have signatures from all members. So in that regard, once you provide your operating agreement to Advanta, we'll make sure you read and approve everything, typically through a DocuSign, and then an authorized signatory from our office will actually be who signs on behalf of your retirement account. It wouldn't be your signature as legally binding on behalf of the retirement account itself. However, your signature as manager is going to need to be present on the document. So obtaining the tax ID, as I stated earlier, it's a very simple process. You can either fill out this SS4 form as I've got displayed for you here, or you could go to the IRS's website. It took me about 15-20 minutes to do this. Very simple and straightforward. At this point, when you're doing this, though, you will need to know what you want this LLC to be named. So it could be Corey Invests LLC or Corey Does Real Estate Investing, whatever you want it to be. It's completely unique and up to you. Again, we just ask that you don't include IRA in the name of your LLC or Advanta in the name of your LLC, just for simplicity's sake. Opening the bank account, I pretty much went over these helpful tips earlier, but just bring a copy of your documentation to whatever financial institution of your choice. If you're not sure or you want a bank account that is with an institution already familiar with IRA LLCs, we've got a few we can reference for you. There's a page on our website, or if you reach out to me directly, I can provide you contact information for those institutions. They're very easy to work with. Again, these are a few that already know about this. Otherwise, there's no reason you can't go into the bank or credit union that you're already banking with and just tell them, hey, basic business checking account, here's my documentation, and get it set up that way. Now, one thing to note as well, a little tip here for you, is typically when you open your bank account, they're going to want some sort of cash deposit. And if you're not yet set up with your account and have a check in hand to make that cash deposit, you may have to just put ahead some money like $25, $50, $100. Once you have the retirement account established and your LLC bank account established and we fund money into it, typically, and this is the only case scenario, you can reimburse yourself for that deposit. And technically speaking, you're not supposed to reimburse yourself, but in the establishment of the LLC, typically you can borrow that $25 or $50 from a non-disqualified person and reimburse them directly. If you want to have your paper trail completely covered, you don't want to actually be seen as paying yourself or returning money to yourself. So you would want to have a trusted friend, non-disqualified relative, give you any cash needed to open that bank account so you could reimburse them directly at the point that we get your money sent over into that LLC's account, whether it be a check, an ACH, or a wire. So operating the LLC, once it's set up and funded, is very straightforward. The chart here basically displays your money comes into Advanta, whether it's a transfer, a rollover, or a new money contribution. We set up and fund the investment into the LLC and push the money into that LLC's bank account. From there, you invest in anything you want to. You send your money out, you deal with your cash flow in, cash flow out directly through the LLC's bank account. But if you want to return money to Advanta so that you can make other investments outside of your LLC, or you want to use this money for any personal purposes, you do have to have that money flow back to Advanta so it can go back over to your fiduciary retirement account, or you can execute a distribution out of the account and use that money for personal purposes like a vacation or when you actually reach retirement age to start living off of that money. You're not able, I can't stress this enough, you're not able to just take money directly out of the LLC and use it for personal purposes, or take money out of the LLC and send it directly to your fiduciary account. It has to flow back to us and be executed via a custodian to custodian transfer or a distribution request for proper documentation and reporting to the IRS. Again, this doesn't trigger or create any taxable events unless you have a tax deferred account and you're doing a distribution that you're not going to roll over into another qualifying plan. So don't worry about any taxable nature here unless you are knowingly and doing that on purpose. It's just the operational flow of how things have to move around. I see a few additional questions that have come in since I've been speaking. So let me see if I can't address some of these real quick. Someone said, can we have a replay of the webinar? Yes, that's typically emailed out to you in about a day or so. Will there still be a requirement to have a bank account for the LLC if I can't read the rest of that. I don't know how to expand the Q&A box so I can read the rest of that question. I've got someone helping me. Maybe Billy, if you can take a look at that one for me. If I buy real estate with this LLC, can I take a loan to buy this? Yes, you can take a loan. It's important to note with your retirement account, or by way of extension, this LLC taking out a loan, it does have to be non-recourse lending. We've got separate educational content on our website and webinars that we've done on non-recourse lending. But this goes under the same rule that I explained to you earlier. Your retirement account is not able to sign a personal guarantee, open up a line of credit, and by extension, not able to take out a general loan like you would with a standard loan or mortgage. It has to be non-recourse lending, which is going to be typically a bit of a higher interest rate. Typically, you're going to have to prove to your lender that the asset you're borrowing for is immediately income producing, and your interest rates are going to be a little bit higher than your standard traditional lending, but it is possible. It just has to be non-recourse. Next question here. If you have an existing Advanta Trust checkbook IRA, how complicated to, that's another one. Oh, there's a read more button. Goodness. Sorry guys, we're switching to a new service, so I'm just figuring it out. How complicated to convert to LLC, arguments pro and con. So if you already have an Advanta checkbook IRA, you typically already have the LLC. So that may be something to speak with your client account manager on. You may be referring to if you already have checkbook control by way of a solo 401k, what we call our DYO 401k. For those of you not familiar with what I'm talking about, I'll get into it in a little bit further. But to the person that asked that question, I'd say speak with your client account manager. You may not need to transition anything. You may just need to just double check what account type or status you have. I scrolled back up to that other question and the read more button is not present on it. So that's kind of weird. Why I'm not able to see the rest of that one that came in at 12:32 Eastern time. What's the age to receive distributions from the IRA? There's not a specified age. You can take distributions out of your IRA at any time you want to. The key factor here is if you have a tax deferred account, typically 59 and a half is the age where you want to hold out, because if you take a distribution prior to 59 and a half with a tax deferred account, you're going to be hit with a 10% early withdrawal penalty. If you have a post-tax or Roth account, it's not necessarily 59 and a half. The rules are a little bit different. Typically, to avoid the 10% early withdrawal penalty, you do have to have your retirement account set up and established for 5 years, what's called the IRS's seasoning or vesting period, before you want to start drawing money out of it. So those are the basics of those rules that you can kind of gauge as to when, how, and why you might want to start distributing. But your CPA or tax preparer should be able to assist you in that further and give you some of the pros and cons and nuances of when and how you might want to start distributing out of your account. Final question before I get back on track with the presentation. If I have a split 401k, traditional and Roth, that I want to roll over into a solo K, do I need to separate accounts, or can it be managed within one account? So if you have a split 401k, you can establish a solo 401k and move over the traditional and Roth funds from your existing 401k into a self-directed one. The only type of funds that are not portable into a solo 401k are existing Roth IRA money. So if you have money in a Roth IRA already, unfortunately, right now with the IRS's rules, you're not able to put that into a 401k, even if you wanted to put it in as a Roth component 401k. There's just not portability based on the IRS's current rules and regulations to do so. All right, I'm going to get back into the presentation before I get too derailed. Anyone, please keep adding your questions. I will address them thoroughly and fully once I get a little bit further in the presentation. So maintaining your Checkbook LLC, once you have it established, again, you just manage everything in the name of the LLC. You fund your investments in the name of the LLC. So if you go buy property, deed of title, if you issue a loan, the lender is all going to be in the name of your LLC with your signatures as certifying as the manager of the LLC, capable of making those decisions and funding those investment transactions. Your cash flow in comes back into that LLC's bank account, not your personal bank account. Your cash flow out always has to go out of that LLC's bank account. You cannot front money from your personal savings and say, oh, I'll pay back the LLC later, or I'll use the LLC to pay myself back later. That is prohibited. You do not want to do that. If you're ever audited in the future and the IRS sees you're doing things like that, that could be a big problem for you later. And the earnings stay in that LLC, so you could reinvest it, you could put it into a high yield savings account, whatever you'd like to do, as long as it stays in the LLC, unless or until you move it back to us to make other investments or push it back over into a fiduciary retirement account or take distributions out of it. That's basically, once you have the LLC, it's your all-encompassing vehicle for your retirement investments. So you can partner this LLC. So basically, when you're partnering, you're either partnering at the LLC ownership level, or you're using your LLC to partner on an investment transaction. So let's just talk about real estate. If I have an LLC and I want to partner my LLC with myself personally to go buy a rental property, very similar to the way the LLC setup happens when you open it and you establish it and you set your ownership percentages. The ownership percentages as well on the deed of title for that property are going to have to state, my retirement account owns X% of ownership in the property, and I personally own Y% of ownership in the property based on the exact dollar amounts that are being brought into the investment. And then all the cash flow in and out for that property need to be split based on that ownership percentage. So let's say I partner 50-50, my retirement account on a property and myself individually on a property. So I'm going to use round numbers, $200,000 property. We both put $100,000 in. If 3 months down the line, we need to put a new roof on that property and that roof costs $10,000, then I need to pull $5,000 out of my retirement account and I need to pull $5,000 out of my savings to make that investment. If it generates property rental income, $2,000 a month, and we're splitting it 50-50 on the deed of title for that property, $1,000 flows back into my LLC and $1,000 goes back into my savings. I may be subject to taxes on that personal side of it, the investment I made outside of my retirement account, but I'm not going to be subject to any taxes for the retirement portion. So how to move money between the LLC or trust. The cash flow, as I've stated a few times, goes into the retirement account, from the retirement account into the investment vehicle, which is the LLC or the trust, and then you make investments. If you want to take money back out, it comes out of the LLC or trust back to the administrator, Advanta in this case, and then you distribute to yourself, you transfer to other retirement accounts, whatever you may want to do. Very simple and straightforward, but it's very important you do this properly. That's why I've said it multiple times, because you don't want to put yourself in a position where you move money improperly, and that could come back as a major problem in the future for you. So with checkbook control, a few final notes. When we're talking checkbook control in general, we're talking a single member LLC. So an LLC that is wholly owned by your retirement account. There's no other progressive or portional owners. While that is still allowed, that's not the general term checkbook control. That's a multi-member LLC, which is handled very similarly in almost every capacity, but there are tax filing required when you have multiple members in an LLC, even if they're both retirement accounts. The checkbook control allows for management to write checks and do things like that. It must be manager managed. You cannot compensate yourself, however, for this management. So this is basically pro bono work, if you will, or equity that you're putting in to the LLC as the manager that you're not able to compensate yourself for because this is your retirement account. You're ultimately trying to generate passive income that you'll utilize later in life when you distribute this money out of your retirement account. And then a few final considerations. The custodian typically offers a one-stop shop if you did that administrative or custodial investment transaction strategy. But checkbook control allows you to act a little bit faster when you're investing. So if you find a deal over the weekend outside of normal business hours, you can transact a little bit quicker. If you're planning to do tax deed and lien investing, you can invest much quicker and execute transactions quicker, pay on an auction that you've won a lot faster than having to wait for our normal business hours, even though we're really fast too. Our client account management team can typically receive paperwork from you and get an investment funded within 24 to 48 hours. But if you want to kind of circumvent that timeline and just have it all in your own hands and at your own control, that's exactly what this vehicle is set up for. There's no secret formula. It's really based on what your preference is and what your level of control and ownership of your retirement dollars is going to be. And again, to reiterate, there is case law that supports that you can establish a checkbook LLC and serve as the manager of it. But again, you're not able to compensate yourself for that management responsibility. So I'm going to go into some case studies at this point. As I mentioned earlier, there are 3 different ways to establish checkbook control, and I'm going to give you a brief case study on each of these 3 ways. The first of which is just setting up a single member LLC. So I've got a gentleman who's got about $150,000 in his current IRA account, and he'd like to invest into real estate by way of an LLC so he can act a little bit faster and just kind of handle the management of that property a little bit more simply than the custodial method. So this gentleman sets up a self-direct account, conducts a custodian to custodian transfer to move money from his managed IRA to a self-directed one, which typically takes about a week and a half tops. And in the meantime, while we're waiting for that money to hit this self-directed retirement account, this gentleman can go ahead and start getting his LLC registered with the IRS and getting his operating agreement put together so that the client account manager, as soon as the money is in the account, can go ahead and execute the transaction and send the money into that bank account that this client's going to establish. Again, all the paperwork, the articles of organization, the operating agreement, and the bank account funding instructions are provided to our client account management team. They execute a transaction and send the funds out to the LLC. And then from there, the LLC can ultimately make whatever investments that that client wants to make. So it's a very simple process, very straightforward. Takes about a week to a week and a half to establish it, get it all paperwork wise good to go, get the money into the account, and then send that money into that LLC's bank account. And then from there, the client handles everything they need to, all internally within the LLC. If they have any questions about rules and regulations, they definitely would want to come back to us and ask those questions, because once you have this money in this LLC, in theory, you could conduct a prohibited transaction because we're not overseeing and telling you, hey, don't do this, hey, don't do that. You're able to do whatever you want. So the onus is on you to make sure you're following the IRS's rules, or if you're not too sure about them, circle back with your client account manager and say, hey, I'm thinking about buying this asset with my retirement funds in this LLC. What are the pros, cons? What should I be aware of? And so forth. So the second way to establish checkbook control is through a private trust. So a private trust, as I stated earlier, is very, very similar to the LLC method. The only difference is when you're establishing a trust instead of an LLC, you have to appoint a third-party trustee that is not yourself and not a disqualified person that'll actually handle the funds, execute the investments in the name of the trust. So it takes a little bit of the control out of your hands, but into a trusted third party's hands. And it also basically makes it so that third party person is actually handling everything at your discretion, obviously. But the key thing here, as I've seen in my experience, is that the trust is not a public listed item. So people can't go online and find out who the owner of this trust is or who the trustee is for your own anonymity purposes. Funding is pretty much the same. Operations is pretty much the same. Just put in place this trustee as opposed to yourself as the manager of the LLC. And then the third way that we see people establish checkbook control is by way of a do your own solo 401k. That is a 401k product we offer where you're basically completing an application and establishing a solo 401k plan for your small business or self-employed enterprise or sole proprietorship. And within that within that 401k, you do not need to establish an LLC because our DYO model is in itself an LLC for you. So basically, you're paying a flat rate per year to lease our 401k plan document, and you're serving as your 401k's own trustee and administrator. You establish a bank account at the financial institution of your choice directly in the name of your 401k, and then you execute all the investments as the trustee of your 401k in the name of your 401k itself. So everything I've talked about so far in terms of the trust or of the LLC, you're doing so in the name of the 401k in this case scenario. So you will have to go establish a tax ID number for the 401k plan itself, and that's what's going to be on all your investment paperwork. This is just again, a third way, probably the least commonly used way that people do checkbook control, but it is probably the most cost effective in that you're just paying us a very nominal flat rate to lease our 401k plan document, and then you're basically maintaining your own 401k plan completely yourself. Now, with this model, you do not have a client account manager to lean on for questions and things like that. You could still reach out to your business development executive, so myself or one of my counterparts that helped you establish this plan if you have questions or concerns, but you won't have a dedicated client account manager appointed to you to reach out to as our other clients would have with a trust or an LLC established. So there are some pros and cons of using the checkbook method. The pros are it's easier to just do things yourself. It's a little bit harder to keep arm's length because you're more so in the weeds with your investment. So you don't have a client account manager overseeing and executing all of your investment transactions. You've got someone on our team when you're custodially doing it. But if you're not going custodial and you're going checkbook, then again, the onus is on you to be aware and follow the IRS's rules and regulations to avoid any possible conflicts. With us doing the custodial account, we're maintaining clear records of all of your cash flow in, cash flow out, different things like that from a bookkeeping perspective. Again, typically you're not having to worry about tax filing, but from a general bookkeeping perspective, you're going to have to keep your own records of that if you go checkbook, which may, for some of you, may mean hiring a bookkeeper or using a service like QuickBooks or something like that, or just having your own version of Excel spreadsheets and things like that that you keep clear and concise records of all of your transactions and cash flow. The cons, basically, of not using checkbook control is that you don't have the ability to make those quick transactions. You can't agree to a private loan with someone, draft up a promissory note, and cut them a check right then, or send them an ACH or a wire. You have to wait until Advanta's normal business hours, reach out to your client account manager. And then again, we typically facilitate transactions in 1 to 2 business days, but that may not be of your liking or of your speed and pace of investing, depending on your own interests and your own strategy and timeline. And again, if you need to put more money into the LLC or take money out of it, you've got to make sure the ownership percentages stay the same if you're doing multiple members, or make sure you're properly flowing that money back to Advanta to move away, or from Advanta into the LLC if you need to add more money into it. So what's the best strategy for you? Basically, with everything I've told you here, it's really a self-analysis. Do you want that day-to-day control? Do you want the oversight of exactly what you're transacting into and the cash flow in and cash flow out? Or do you want the custodian or administrator to handle that on your behalf, making things a little bit smoother, but less money in your hands, access direct control to the investments that you make and the time that it takes you to make those investments? So the key takeaway points I want everyone to walk away from today's presentation with is checkbook control is a great strategy for investors seeking flexibility and freedom. There are some specific considerations when you set up an LLC, a trust, or a DYO solo 401k with checkbook control. So make sure you're setting it up as manager managed. Make sure you're appointing a third-party trustee. If you're doing the DYO route, make sure you establish a tax ID number and you open a bank account directly in the name of the 401k plan. We're there to help you through that process of whatever strategy that you take. Make sure we're setting it up effectively and efficiently for you. And then finally, which I've said numerous times ad nauseum, the cash flow has to either stay in the LLC or flow directly back to Advanta before you move it into another IRA or take it out for personal purposes, which is going to be a documented distribution out of your account. I'm going to look back here at the questions, if anything new came in since I started. Would there still be a requirement to have a bank account for the LLC if I have a dedicated brokerage account specifically for the LLC? You do not have to have a checking or savings account if you just want to have the LLC and establish it at a brokerage. You need to make sure the brokerage account is titled in the name of the LLC. But as long as you have somewhere for us to send the LLC's money, then that's perfectly fine to utilize a brokerage instead of a checking or savings account. What is the procedure for funds in a checkbook IRA with a bank be transferred to a brokerage account? Similar to that last answer, you do not need to have a LLC checking or savings account if you're ultimately going to establish a brokerage. If you're not sure or you're going to establish a brokerage in addition to other investments you make, then you establish the LLC, you move the funds into the checking and or savings account at the financial institution of your choice, and then you establish a brokerage account and move the funds from your LLC into the brokerage account directly. Either way, it's whatever your choice is in that capacity. You responded that there are no reporting requirements at all. In another webinar, one of your colleagues said that on an annual basis, one must report the value of the account, so I'm confused. You're required to report the value of your account by way of what's called a fair market valuation to your administrator. We then convey that to the IRS, but that's not a direct requirement of you to report anything to the IRS. That's a standard IRA custodial requirement to report the value of every asset held in your account by way of a fair market valuation form to your administrator directly. The question I was answering earlier, where this may be a little bit misconstrued, is that there's no direct IRS filings that you need to make on an annual basis. What you're referring to that my colleague, I'm sure, covered was the simple fair market valuation requirement that you're required to do for every retirement account you have. Typically, if you have a fiduciary account, they might be just doing it on your own behalf by pulling the current status and values of all your investments without having you have to sign off on anything further. But with alternative asset investing, it's typically an item that we reach out to our clients and collect for each asset they hold. If I took a small distribution, do I still have time to roll it into another type of IRA or 401k within 60 days? Yes, the 60-day limit is called the indirect rollover or 60-day rule. If you distribute money out of a qualified retirement account, you have 60 days from what's called constructive receipt, meaning the day that the funds hit your inbox, mailbox, wired into your bank account, that you can roll that back into a qualifying plan and allow it to re-enter the retirement account status. Outside of 60 days, you're basically stuck with that money and any possible tax consequence that came with taking that money out. And also, if you do this, you're only allowed to do it once every rolling calendar year. So if you did it today, before you're allowed to do an indirect rollover again, you have to wait until January 20th of 2027. Which crypto exchange do you guys use? We have relationships with, I think, 3 or 4 crypto exchanges. If you reach out to me directly, I'd be happy to give you that list. I'm not going to name one versus the other here, and I don't have all of their names handy at the tip of my tongue. So just reach out to either myself, or if you're an existing client, your client account manager, and they can share with you the crypto companies that we have established relationships with. Real estate question. If I partner with myself, can I use cash from the LLC and funds that I would borrow for myself? You cannot borrow for or from yourself. So the answer to that is effectively no, if I'm reading it correctly. Your LLC cannot be used to lend money to yourself personally. That flows back into the disqualified persons rules I referenced earlier. Another real estate question. If I partner with myself, can I set it up so that either income or expenses are split differently than the percentage ownership? No, it has to be set based on the ownership percentage. There's no way to circumvent or change that. It's an IRS regulation. Can you explain how asset fees structure is lower with LLC? Yes. So our fee agreement is 2 different options, basically. Our clients are billed a flat rate per each asset holding they have, or a value-based rate, so based on the total value of their account with us. Most of our clients are on the flat rate per asset. When we're talking about the LLC is the only asset we see on our records and have on our books. So if you're going to have 5, 6, 7 different investments that you're planning to make with your IRA account, setting up an LLC and holding those 5, 6, 7 investments within the LLC is going to reduce the multiple of flat rate per asset annual maintenance fees that you have by whatever that multiple is. So again, most of our clients are on a flat rate per asset fee agreement. The LLC itself would be the only asset we show on our books. And then within the LLC, you can have as many assets as you want that you're not being charged a flat rate for each of them. Is it required to have the IRA for 5 years before getting a distribution? No, what you're referring to is the 5-year rule for a Roth distribution. I would implore you just to go to the IRS's website and look at the 5-year Roth distribution rule. It's not required, but it does impact if you're trying to distribute prior to those 5 years with additional early withdrawal penalties and charges that you may be assessed. If I will be an LP in a real estate syndication, I will not need a checkbook, right? Correct. You do not need to have checkbook control to be a limited partner in a syndication. You can do that investment custodially directly through us. But again, if you are going to hold multiple syndications, setting up that checkbook LLC may help you cut down on your administrative fees. And I know we're running long on time here. I'm going to try to get to these last few questions. Can I transfer cash from my trust, checkbook, SD IRA directly to a brokerage account? How? The trust would need to basically establish the brokerage in the name of the trust, and the trustee would need to send funds to that brokerage account. Another related question, if there is no tax reporting, then how does anyone about UBIT tax and how is it reported? Separate topic, check out our educational content on UBIT and UDFI. That is a reporting requirement if you're subject to UBIT or UDFI tax. That's something I stated very early in the presentation. What is the fee for opening and operating said LLC? I do different investing in multiple sectors. Yes, you can email me directly and I'd be happy to send you our fee agreement and discuss that further with you one-to-one. Does the LLC include only my Advanta properties and not my other IRA brokerage accounts? Correct. They would only hold the properties and assets that you invest into or move into the LLC. Your brokerage with another provider would stay your brokerage with another provider. That's an IRA you hold with that company, not with us. That is pretty much it. Can the Checkbook LLC be used as a holding company that owns additional, say, 3 LLCs? Yeah, you can set up basically an umbrella LLC. And then so let's just say I set up Corey Invest LLC. Corey Invest LLC can then be the member of Corey Invest in House 123 Main Street, Corey Invest in House 345 Main Street, and so on and so forth. As long as that initial LLC that you're calling a holding company in this question is the member of the subsequent LLCs, that would work for you. It does get a little complex, so some people may avoid that type of strategy. But if you're trying to hold real estate and you want each real estate property to be their own LLC, establishing the first overarching Checkbook LLC and then establishing each subsequent LLC under that as held in membership by the first LLC, that could work for you. I believe I've answered all the questions. If anyone else has anything further they'd like to ask, you can go ahead and reach out to me directly. I've already provided my contact information. I'll put it back on the screen here for another moment or two. Thank you all very much for participating in today's webinar and dealing with some of my slight technical difficulties as I'm just learning our new system. Thank you all very much. Have a wonderful rest of your day. And you will receive a recording in about 1 to 2 business days, but you can also, again, just reach out to me directly if I can answer or assist you with anything further. Thank you.